$38 trillion. That is America's national debt right now. Not a projection, not next year. That is the actual debt on the books as of December 2025. If you believe that number is just an abstraction that doesn't affect your personal bank account, you need to pay close attention to the data I am about to present. While the general public has been distracted by entertainment and political theater, the largest financial institutions in the world have begun an unprecedented shift. For the first time in 75 years, they are quietly and systematically moving massive amounts of capital out of dollar-denominated assets. This is not a conspiracy theory. This is documented capital flow based on public filings and treasury data. By the end of this video, you will understand exactly why this is happening and what comes next. We are witnessing a mathematical pattern that has played out 3 times in the last 500 years. It involves the same stages, the same warning signs, and the same devastating outcome. The only question is whether you will recognize the signal or be left asking how you missed it. According to the IMF's latest data, global debt has hit $251 trillion or 235% of global GDP, the highest ratio in recorded peacetime history. U.S. debt alone jumped from $36.1 trillion in January 2025 to $38.4 trillion by December, a $2.3 trillion increase in just 11 months. This exact scenario has occurred 3 times in modern history. In every instance, the country holding the global reserve currency collapsed within 36 months of the smart money exiting. The pattern is mathematical, predictable, and historically unstoppable once it reaches a tipping point. The 4-stage cycle. Every major economic collapse in the last 5 centuries followed this precise cycle. Stage 1, the ascension phase, 50-80 years. A nation becomes the center of global finance. Capital floods in, the currency becomes the standard for trade, banks expand, and innovation accelerates. Confidence is absolute. Stage 2, the overextension phase, 20-40 years. Success breeds arrogance. The government spends beyond its means on military expansion, foreign intervention, and domestic programs, all funded by debt. Debt grows faster than the economy, but asset prices, stocks, real estate, keep rising, masking the rot. Central banks print money to sustain the illusion. Stage 3, the silent exodus, 18-36 months. This is the critical phase we are in now. The smart money, institutional investors who read balance sheets, sees the math doesn't work. They quietly rotate capital into safer jurisdictions. Foreign investors reduce holdings. This happens without press releases. Stage 4, the collapse. The currency loses reserve status. Foreign central banks dump holdings, inflation explodes, interest rates spike, and asset prices crash simultaneously. Let's prove this pattern with 3 historical examples. Example 1, the Spanish Empire, 1500s. In the 1500s, Spain was the undisputed superpower. The Spanish real was the global reserve currency. Madrid was the financial center of the world. Wealth poured in from the Americas. Stage 1 was complete. Then came Stage 2. King Philip II spent fortunes on wars with France, England, and the Ottomans. By 1550, Spanish government spending was running at 300% of tax revenue. They borrowed the difference from foreign bankers, but because gold kept flowing from the colonies, nobody worried. Then, the Stage 3 exodus began. In 1555, major banking families like the Fuggers began demanding repayment in gold, not promises. In 1556, wealthy merchants began moving operations to Amsterdam. They saw the balance sheets. Spain was paying 40% interest on loans. In 1557, Spain defaulted. Credit markets froze. The government seized private assets. Spain defaulted again in 1560, 1575, 1596, and 1597. The currency collapsed, the middle class was wiped out by inflation, and the Golden Age ended. Capital moved north to the Dutch Republic. Example 2, the Dutch Republic, 1600s, Amsterdam became the new center of finance. The Dutch East India Company was worth $8.28 trillion in today's money, more than Apple, Microsoft, and Amazon combined. The Dutch guilder was the world's reserve currency. Then, the wars returned. The Dutch fought England, France, and Spain. Government debt exploded from 4 million guilders in 1650 to 80 million by 1690. To pay for it, they printed money. Asset prices detached from reality. This was the era of tulip mania, where bulbs cost more than houses. The Bank of Amsterdam began secretly lending depositor money to fund the government, a hidden fractional reserve scheme. Stage 3 began in 1690. Major banking families and merchants began transferring operations to London. Insiders knew the Bank of Amsterdam was insolvent. In 1795, the French invaded, the guilder collapsed, and the bank's fraud was exposed. 150 years of dominance vanished. Capital moved to London. Example 3. The British Empire, 1700s-1900s, Britain controlled 25% of the Earth's landmass. The pound sterling was the reserve currency for 200 years. London was the financial hub. Stage 1 was absolute. Then came the 20th century. 2 world wars cost Britain the modern equivalent of $600 billion. Debt went from 30% of GDP to 130%, the exact level the US is at today. They tried to hold the gold standard and failed in 1931. By 1949, the Stage 3 exodus was underway. Corporations like Unilever and Shell shifted investment to America. Wealthy families moved assets to Switzerland and the US to escape high taxes and a declining economy. By 1960, foreign investment in Britain had plummeted 62%. The result? In 1967, the pound was devalued by 14.3% overnight. In 1976, the former superpower had to beg the IMF for a bailout. The pound lost reserve status, and the dollar took over completely. The United States, Stage 3 is here now. Look at the United States. Stage 1, 1944, Bretton Woods established the dollar as the global reserve. 1945 to 1971 was the era of dominance. Stage 2, 1971, Nixon ends the gold standard. Spending explodes. National debt goes from $900 billion in 1980 to $38.4 trillion in 2025. That is a 4,200% increase. Total U.S. debt, including corporate and household, is over $100 trillion or 370% of GDP. We now pay over $1 trillion annually just in interest on the debt. To fund this, we increased the M2 money supply by 40% between 2020 and 2022. The Federal Reserve's balance sheet ballooned to $9 trillion. We bought our own debt to prop up asset prices. Stage 3, the exodus. This is happening right now. China has dumped over $300 billion in U.S. treasuries since 2013. Japan has reduced its position by $220 billion since 2022. Saudi Arabia, France, and Switzerland are reducing exposure. BlackRock and major institutional banks are restructuring portfolios to increase exposure to commodities, emerging markets, and real assets while reducing heavy dollar concentration. Furthermore, the petrodollar system is fracturing. While the headlines about the end of the agreement were sensationalized, the reality is significant. Saudi Arabia is actively exploring settling oil trade in other currencies. The BRICS nations, representing 40% of global GDP, are building infrastructure to bypass the dollar. The America is different fallacy. You might think America is different. We have the military and the tech. Spain had the strongest military in the 16th century. It didn't stop the collapse. The Dutch had the most advanced financial tech in the 17th century. It didn't stop the collapse. Britain had the largest empire in history. It didn't stop the collapse. Military power does not override economic mathematics. And printing money, that led to hyperinflation in Weimar Germany, Zimbabwe, Venezuela, and Argentina. It transfers wealth from the middle class to asset holders until confidence breaks. What happens next? Stage 4. When the dollar loses its dominance, the trillions of dollars held overseas will flood back into the U.S. economy. Inflation will go vertical. The Fed will face an impossible choice: raise rates to kill inflation, which crashes the debt-laden economy, or keep printing, which destroys the currency. Asset prices will crash as liquidity evaporates. Stocks, bonds, and real estate will deflate simultaneously. Your action plan. We are likely 12 to 15 months into Stage 3. You have time, but not much. Here is what you must do. Diversify assets. If you are 100% in dollars, you are exposed. Look at assets that hold value during debasement. Gold, up during every collapse. silver, and commodities. Geographic diversification. Consider holding some assets in jurisdictions with stable currencies, Swiss franc, Singapore dollar, to hedge political risk. Increase liquidity. Cash loses value to inflation, but having accessible capital allows you to buy real assets when prices crash. Deleverage. Reduce high interest debt immediately. In a rising rate environment, debt is financial suicide. Invest in skills. Human capital, skills, and relationships cannot be inflated away or confiscated. Stay informed. Do not wait for the evening news to tell you it's over. By then, it's too late. The pattern is clear. The data is verifiable. Spain, the Netherlands, Britain, they all followed this path. America is in stage 3. The smart money is leaving. Subscribe and hit the bell, because in the next video, I will break down exactly which specific sectors historically outperformed during stage 4 collapses and how to position yourself to not just survive, but potentially profit. The pattern is unfolding. The choice is yours.